Okay, if I turn my camera off, I
Yeah,
don't
no
really
problem.
want to be recorded. Is that
No
okay?
problem at all. No
Thank you.
problem at all.
I will also switch off my camera. Yeah.
Yeah, not at all an issue. Right. So thanks for joining in. In today's session, we're going to look at the Octo factor model. And this is basically a proprietary model that Helix uses. Um, Not something that is very, very new, but something that I have used personally over the last, I would say, 25 years plus. And I've kind of rearranged some of it, added a few factors here and there. So, what used to be, I can say, about 14 factors earlier now has become a consolidated 8 factor sort of a model. And underneath those 8 factors is essentially the way in which we can generate alpha. So for anybody who doesn't know what alpha is, this is basically outperformance over the market, right? So if the market did 10% and our strategy did 11%, then we say there is 1% alpha in it, right? As a very simple example. What we're going to do today is we're going to walk through what these factors are, how it is used, how the portfolio is really structured, and also talk through why we do certain actions, etc. Right. So that will be pretty much the content of this particular session. And as I mentioned, the portal now contains a learning hub. So on the learning hub, what we've done is we've curated uh, content from our Substack, from our YouTube. My books are there, as well as there is also information, some basic content that um, would be quite helpful. We've basically taken that and we've essentially curated this for anybody who wants to explore, explore learning about this. This is pretty much a good uh, sort of a resource to get started with, right? Now, what we are going to do is first of all look at how the market misprices integrity and what we are essentially doing about this, right? So in the market, there is fundamentally what we tend to do is we look for passive investing. So a vast majority of us are passive investors. We are chasing beta, so essentially correlation to the market. So a vast majority of us would select a market cap weighted index fund, and we would invest into that using our wrapper based account like ISA or SIPP or an equivalent account anywhere in the world, right? So with that, what happens is that we are looking at how we can diversify and get value out of the entire market. And then within that is basically the bigger and bigger the company becomes, the more and more of your capital goes and gets allocated into those companies. But unfortunately, stock market returns were never generated using that sort of a model. Right? Stock market returns always depended on concentration and, more importantly, uh, looking at the size and valuation of companies. So that is the traditional model that we are basically talking about over here. So while within the standard, I can say the public market infrastructure, right? This kind of a market no longer exists in reality. This kind of a market no longer exists, and this is basically the reason why we talk about this is since the last maybe 10 years plus that we've been observing um, you know intensely around sort of global stock markets. What we've noted is that um, the sustainability of the value generation is lost in this game. And by meaning sustainability, I'm not saying this is green, no, that is not sustainability in itself. Sustainability really means that you are able to sustain that growth over a uh, longer time period. And more importantly, the integrity of the operations has been grossly ignored by this market mechanism. And when I say integrity, what that means is the company walking the talk? Number one, when they are talking, are they really having the required financial wherewithal to go and execute that? Number two. Number three, are they cooking the books? Number four, is the market really shrinking, but they are actually playing it up, saying that, yeah, this is fantastic, I'm growing revenues 20%, 30%, whatever. Are they trying to do that? Right? Unfortunate fact is nearly about 93% of all listed companies around the world fail this test. Right? So in reality, your index fund, your portfolios, etc., contain a vast majority of these 93% companies that fail the test. And this is where we basically took a radically rethinking sort of an approach. We said, okay, I'm not an idealist over here. I'm not here saying, yeah, greed is good, this is good. Then I'm not going to throw capital at something based on somebody's narrative. We basically look at it as, is there a fundamental decoupling that is going on, and can we basically sense that earlier? And this particular forensic integrity is what we are looking at in this 8-factor model that we are going to talk about. And this integrity means that we are able to identify the best kind of undervalued stock maybe between 12 to 18 months before the market identifies it. So by the time your analyst or your fund manager identifies it and they basically talk about it, and you are basically looking at it everywhere in the papers, etc., we have already extracted the juice out of that particular stock. We entered in 12 to 18 months before we are likely to exit a stock when it is fairly valued, right? So we won't stay in the market when it is slightly overpriced or whatever, right? So we tend to go out of the market quite at the point where it is kind of fairly valued. So that essentially is what happens. So by the time other analysts or let's say financial media talks about this particular stock, we've already extracted the juice and we've left that particular stock. Essentially, that is how this particular model works, right? So on the left, you've got various sort of traditional models. Many of you might be aware of the CAPM model, capital asset pricing model, and then there's Pharma French, etc. There are a number of factor models that are available, Carhart, etc. But these are built for a market that no longer exists, right? And this is where we are essentially in terms of how this particular model works. So these are the 8 factors that we use. Full transparency in terms of what factors we use. We are looking at market risk, size, value, profitability, investment, and momentum. So these 6 factors are the risk stabilizers for us, right? These are the baseline, you can say, the foundational elements of the model, but they are not the ones that actually generate alpha, right? The real ones that actually generate alpha are two factors, which we call the integrity and health factor at the top, and the eco efficiency factor. Right? These are the two factors which I can say reasonably generates a significant part of our returns, right? And then all these factors essentially allow us uh, to kind of manage the baseline, extract the value way before uh, way before the market prices this, and you know we will be able to we'll be reasonably be able to exit the stock by the time it is fairly valued. So most of the stocks that we are uh, looking at are maybe 60%, 70%, 80% undervalued. And by the time they are fairly valued in the market, we have taken our profits and we have exited that particular stock. So what is this integrity and health factor? We are combining three scores together, which we call as the IHF signal. So number one is solvency. So do they have the right finances uh, to kind of tackle what they are trying to do? So let's say they are building data centers and they are actively scouting AI opportunities, etc., etc. They are saying that AI is a big game, blah blah blah, and that's the message that the company is actually talking about. Do they have the financial wherewithal to do this, or are they going to be attracting the basically going to the equity markets or debt, etc.? But when they basically take this on, are they able to sustain it? So is revenue growing enough basically to pay for that expansion? So that's basically one side of it. The other side is basically the fundamental quality. Um, you know, is the company's operating efficiency pretty good? Is their profitability really good? Are they at a point in the market where they are able to leverage the right pricing? Right. Again, markets change, market structure changes. Some companies that were able to price their products really well. So take for example, pretty much essentials, right? So in today's stagflationary kind of a regime, prices are being pushed, and because of that, essentially their margins will not grow as much as expected in the kind of a situation that we had back in, let's say, 2024. So what is stagflationary regime means? On one side, the inflation is high, and on the other side, GDP is not growing that much, right? So with these two compressions taking place, we call the current regime, that the current macro regime that we are in, that is called as a stagflation. Though many of our financial media and whatever analysts, etc., like to present it to us as if we are in a growth stage, and in fact, the stock market can pretend to be in a sort of growth stage. That's not the reality, right? The unemployment's we basically track unemployment numbers. We basically look at interest rates. We look at the inflation numbers. We look at essentially GDP growth quarter on quarter. The current situation where we are in US, UK, European markets, we are essentially into a stagflationary regime. And we also have the M score. This is basically the earnings manipulation score. Basically, the truth is, you have three financial statements for a company. You have the balance sheet, you have the profit and loss, and then you have the cash flow. Nearly 90% of companies try to cook up at least one of them, right? Unfortunately, they're not able to cook up all three, but this is a score that will pick it up for us, right? This will kind of tell us, okay, fine, this is good, tolerable level of manipulation, but yeah, it's okay, be careful about it. Or it says hard stop, don't even touch this one, right? So these three scores in combination, we use a certain ratio in which we can kind of combine it. This becomes our stress test to see, is this worth entering into or not, right? So is this like a stock screener? Is it like a filter? Most of your stock screeners, if you use, various financial tools and whatever, we use stock screeners. These are built with the assumption that stock returns are following some sort of a normal distribution. So if you follow all the rules, all the returns should basically accumulate towards the center. No, the reality is stock returns are fat-tailed, right? So you will have one particular year in one particular stock where stock returns will be massive, and then in subsequent years it will be significantly low, right? So this is not a screener. This is basically a hard filter that we use. I'll also talk about the other alpha generator, which is the eco-efficiency factor. Now, you might not like sustainability, you might not like green, you might think Trump is the God's gift to the universe. That is fine. But unfortunately, since about 2015 onwards, a vast majority of stocks in the market use what is called as ESG scores. Vast majority of them. You might be able to find a few very small or maybe nano cap stocks that don't have ESG ratings or scores, but a vast majority of them have ESG scores. They have sustainability reports. They have their own. If you're a listed company, you're obviously going to have some level of sustainability related work being done over there. But here is a very important question. So there is sustainability talk and there is sustainability work. And in most of the cases, that gap is very, very wide. Examples, they are hiring more number of PR communications kind of people to write the right kind of reports. They are hiring people in finance to do some calculation. They are not hiring enough engineers to actually do the work. So that means the talk volume is high, the walk is not that great. There is also the other side, which basically is that some business models are fundamentally not sustainable. Take Airbnb as an example. They have one of the industry's best sustainability scores. They're the best ESG scores that a stock can ever have. But unfortunately, they have an unsustainable business model. How does the Airbnb business model work? It works by prioritizing short-term rental, which means that you're trying to push renters out of the market. Is that a sustainable model? No. You might get maybe, let's say, an eco lodge at some location, and then Airbnb is saying we've created a sustainable proposition, or they might give you a sustainable juice or an eco juice, for example. That is not sustainability. Their model is not sustainable, irrespective of whatever ratings that they might get. So this factor actively looks at basically what is this gap, and if that gap is wide, then it actively punishes that, right? If the gap is not that wide, it is maybe reducing, then it basically gives that particular stock a better rating, right? Yes, Shilpa, you have a question.
So that's really interesting about the Airbnb example that you just gave. So you're saying that they've got a really high ESG score, however, they don't have a sustainable business model. So how do they get the really high ESG score? It just seems to be
ESG
so far apart.
Yeah. ESG scores are not a validation of the business model, unfortunately. ESG scores are pretty much like credit scores, right? So essentially, the rating agency uses a model, and as per the model, do you have this particular report in place? Yes, tick. Do you have this one? Yeah, tick. Uh, that's how this works, right? If if you're trusting an ESG fund with the best scores, etc., that is a very good chance that they will even have fossil fuel assets in there, and they will call it an ESG fund. That's reality out here,
Yeah.
right?
Okay, I understand.
Yeah, if you need some examples, go into any of the ESG funds, and there's usually like a top 10 holdings that's available. Or if you go into Morningstar, you can do an X-ray of the fund. You will see that your ESG fund, which you think is green and whatever, actually holds fossil fuel assets like Shell and ExxonMobil and Chevron, etc., as part of their top holdings. How is that ESG? Right? That's the reality in the market, unfortunately, Shilpa.
Yeah, no, thank you. That's really interesting. I was looking into a company actually for job purposes. It's actually a floral business called Bloom and Weil. So, and they're shouting about all their sustainability credentials. However, somebody was saying, that one of their major investors is Barclays, who is a big funder of fossil fuels or non sustainable kind of like practices. So then,
yeah,
on one hand, so again, there's this imbalance, isn't there? It's they're saying one thing and they're doing one thing, but then they've also got something else going on as well. So yeah, okay, interesting.
Correct. And one of the important factors here is Helix and myself over here, we are not idealists, right? We are capitalists. What I'm looking for over here is if the gap is wide, I'm giving them a lower valuation. That is how I work on this, right? I'm not here to go and tell the company do something better. I actively punish them, right? I punish them by moving capital into a short. If they're doing really well, I actually support them by going long on it, right? That's how I work, right? That's how this fund works. That's how Helix's Octo factor model works. We are not here to go and tell the company do better, right? That's not our job. If they do better, we'll basically be able to extract a little bit more juice out of it. If they do even worse, we will be able to extract more juice out of it, right? That's essentially how this works, right? Now, on that same aspect, there is also this triangular conflict, which has come to light more and more in the last, maybe 10 years plus, right? So in the past, many of this information has not been available in the sort of public records. I think one of the first instances was the fact that the UK created its climate change committee, and then it also did the Net Zero Act back in I think 2010 or whatever, right? So with that, what started happening is that there is a lot of litigation on the environmental and social side that is now publicly available. Have there been environmental litigations in the past before 2015? Yeah, there's basically lots of them, but it never hits the headlines. It never comes into common people's knowledge until about 2015, right? From about 2015, these things changed. Are you taking note of that? That is the key question here. Does this happen? Should it happen? Should it not happen? Not my problem. Are you taking a note of that? And are you able to value these companies based on whether they have litigation in place, based on whether they have this kind of a let's say a triangular conflict here? great examples. If you're saying, my supply chain is cheap, etc., not necessarily the cleanest one, right? So can this come and hit the company later on? Yes, it can. And in most of the cases, it hits them at their low point. It hits them at a point where their finances are already struggling. So that's exactly where it kind of hits. The other one is also that, uh, whenever growth targets come in, as in the case right now, like, with AI and, all the hype that is going on currently. So all the work that is basically being done is whenever growth targets drive wage compression and workforce reductions, that is another side that this particular triangular conflict essentially works in. So if you've got ecoeconomics 1, it talks about the basically this particular triangular conflict, and it is a source of alpha essentially, right? So the other side is also that, let's maybe take Nvidia as an example. Nvidia is another, I can say, top-rated ESG stock, but if you basically strip down the ESG ratings and look inside what really happens inside Nvidia, first of all, they've got an unsustainable supply chain. They are totally dependent on a Taiwanese manufacturer, and that is where most of their work gets done. And on top of it, their chips actually generate more heat and essentially need more cooling. So with that, are they really sustainable? At the core of that business model, are they sustainable? No. Is your product sustainable? No. Do you have a supply chain that is sustainable? No. But ESG rating, fantastic. Same is the case with Microsoft. I can go on with Google. I can go on with various other companies that have excellent ESG ratings, but as they grow their revenue, it will become more and more unsustainable at the core, right? So this particular structural tension zone is where we find a lot of alpha, right? So we are actively looking at this and saying, okay, fine. Is there a structural tension in here? And when that structural tension starts hitting the balance sheet, how are they reacting to it? And based on that, can I go long or should I go short on this particular stock? Right? That's how we tend to use this. If you essentially look at most of the factor models, most of the investing models that we tend to see, and also the way portfolios are constructed, what they will tell you is, for say, take for instance Nvidia as an example, right? So for Nvidia, the competitors are Intel. Nvidia is making chips, Intel is making chips, so this one is a competitor. So I'm comparing this one to this one. Many analysts tell you that. But this is where we put in one particular rule. We call it the Nvidia rule, but it's not only for Nvidia, but can be used for any stock itself, right? So it kind of disqualifies when there is a gross margin differential here, right? So as an example, Nvidia gets 70% gross margin, Intel gets 22%, 23% gross margin on its kind of legacy CPU sort of business. So we don't take Nvidia and Intel as competitors. We would look for other competitors for Nvidia. So comparing to the right peers is a very important factor if we have to understand how that industry is working, right? Then you also have another very common sort of a misconception in the market. we call it the TCS rule, right? But essentially, what this is a stock could be listed in the UK, but they are generating most of their revenue abroad, right? In the case of TCS itself, it is an India listed IT company, but they generate 90% of their revenue from US, UK, and Europe. So it doesn't make any sense for me to compare TCS with another IT company in India. So similarly, many of the FTSE 100 companies, they are not a comparison essentially among themselves, because they don't generate revenue in the same geographies itself, right? So as an example, if they are generating most of their revenue from abroad, and in fact, I always say this as well, the FTSE 100 does not represent the UK economy at all. So if you're hearing an analyst tell you the FTSE 100 delivered 25% last year, the UK economy did really well, they're basically bluffing this, because it's got nothing to do with the UK economy. Most of the revenue for FTSE 100 companies came from abroad. So where is the revenue generated? Is the gross margin comparable? So that is the sort of correlated peer set that we use. So we are not going to compare it with an entire tech sector or an entire consumer product sector. We're going to compare it with maybe 3 to 5, maybe 6 companies, right? If you compare it to a very small set that is closely related, we understand the market structure much better, right? We are not comparing it to a broad tech sector and say, this is doing better than that. And that is nonsense. We are only comparing it to companies that are doing similar sort of business, similar sort of margins, similar geographies. So we know, okay, is the market working really well? Is the gross margin improving? Are the revenues improving? If the revenue is improving for all 3 of them, how much is this company better than the others? So for all of the factors, this peer comparison fits in. And your index fund and many other funds actually sit within this particular pool, right? So we're using, you might have gone to the gym and you might have seen this sort of a barbell. So we've got 2 poles. So there is a defensive pole and there is basically a conviction pole, right? These are the 2 that we invest in. And we are very light. We are not looking for any mediocre stocks at all, right? So mediocre stock is, and it'll definitely give you dividends. It'll definitely generate 1% more than the market. We're not interested in any of that at all. So we don't take, so that's all in here in this particular connector, right? So what we will do in this connector is we basically hedge against the market. So we will take a small hedge in there. So on one side, we've got cash generative, forensically clean, large cap sort of anchors. This is the structural safety buffer. And the other side is, there is basically the idiosyncratic alpha. So companies where green walk reality is vastly ahead of the market pricing. Examples, Tesla. Tesla, we actually price it at about $50. $50 per share. They're trading at about 400, right? So this is basically the conviction pool, right? So those sort of stocks we basically go short on them, and as the market reprices that, we will basically make money on that, right? There is no middle ground as such. We are not looking for any mediocre stocks at all, right? So so if somebody comes and asks me, what is your opinion on this? I don't have an opinion on basically on any of the mediocre stocks at all. Okay. So in the last 10 years, so this is based on a back test. So in the last 10 years, how did our alpha sort of attribute towards, right? So among the 8 factors, the 2 factors, IHF and EEF, the integrity and health factor and the eco-efficiency factor. These two factors contributed to about 54% of our returns. The quality stabilizers. So this is profitability, and we also use basically a hedge against the S&P 500 index. So these two together gave us 36% of our returns, and sort of commodity beta, right? The market beta and basically the value, size, etc. This gave us about 22% of our returns, right? A vast majority of our returns are generated by this, and this is essentially low variability, meaning 12 to 18 months, even 24 months, it's not going to change, right? And that is where we are basically focusing more of our energy. So we are not in this game of in fact many of our clients used to ask, you're running a fund, you're not sitting in front of the terminal every single day. No, we are not doing that at all. We are not in this game of looking at the market every single day, moving up and down and this and that. We are observing it, but that's not what we do, right? We are looking at low variability, high precision sort of alpha that we are able to generate over the long term. So this is our risk-adjusted performance where we sit. We've compared it to a couple of hedge funds, right? Both these hedge funds are quite large in comparison to us, right? Both of them had annual returns of 12. The Citadel fund gave 18.2%. The Millennium Fund 12.8%, and our average over the last 10-year period is 63.4%, right? More important, our drawdown is about 6.5%. So at any point in time, our valuation is not going down anything more than 6.5%. Some of these funds, the S&P 500, which we all consider as very, very safe, the maximum drawdown during this particular period is 33.9%, right? So these are some of the risk-related ratios, but more important is the Kalmar ratio. So for every 1% of drawdown risk, the Helix model delivers 9.75% return, basically for every 1% of drawdown risk which we are taking, right? So that's what we've kind of delivered so far. So there are a couple of case studies in here. Unilever is one of them. So 2019 onwards, we've kind of observed, and then if you basically look at 2021 or so, the ESG hype was basically peaking, and many ESG funds were owning Unilever. There's a vast majority of funds were basically owning Unilever. And then if you see in 22, they had a failed bid on GSK, GlaxoSmithKline, and then there's basically a 10% single day drop. So we flagged it about 12 to 18 months before, and we kind of extracted that juice, and we were pretty much out of the stock before this this particular mandated selling started happening. Right. Another example, there's a company called NextEra Energy. They, if you basically look at how the market talks about NextEra Energy, is that this is a utility stock. There isn't much in there, and they are basically selling solar energy to corporate customers. They are not paying much. Sorry, the sort of reality here is they are selling solar power to Microsoft, Amazon, and various top companies on 5-year, 10-year, 15-year contracts. That revenue is solid, right? And on top of it, they are saying, they are basically doing a lot of heavy engineering work. It generates a lot of emissions. Absolutely not. It's basically a solar power company. There is absolute decline in emissions. They are hiring a number of engineering grads, etc., which means that they are doing more of the walk, not the talk. The kind of financial success and environmental mandate are quite aligned. Basically the triangular conflict resolves in a sort of positive manner. So we we kind of took that and we said, okay, fine, the debt is not too bad. It is kind of stable, consistent outperformance. So we basically gave it a shot, right? So this is how we kind of look at this. So this is an example of the eco-efficiency factor in practice. I will kind of stop at this point. Happy to answer any questions. That's pretty much the essence of the model, essence of the Octo factor model, and more information, learning resources. There's a number of simulations, etc., available on the portal. If you just go to portal.helix.earth, there is lots of information that's available in there. You can go simulate your portfolio based on some popular funds, or if you want to upload your brokerage statement and compare it to various popular funds and to Helix, it's basically available on the portal as well. Right. Happy to open it up for any questions. Yeah.
So, Anand here, Soumi.
Yes, Anand.
So I understand that the IHF and EEF is generating the extra push of alpha, and basically it is trying to forensic analyze the data points of the company and find the loopholes. And is it generating the alpha with the help of contra trade primarily, or is it finding the company at the early stage and riding the
there's no contra here. There's no contra. Contra strategies have usually produced negative returns, right? There's no contra in here. So we are looking for undervalued stock 2-3 years before. That is one side. And we are looking for companies that have a very high narrative, but basically lower walk. So in those cases, we are taking a shot, right? Okay. This is not a contra strategy.
Okay. What I meant is contra in the sense by after understanding that the company is reporting a false data points or data which is a vulnerable point of view, we generate extra alpha using the short.
Short is not contra, Anand. Contra means going against the market.
Yeah. Right. No, that is what I meant is, okay, if everybody is going long, we are going short. Or is that way?
No, there are a lot of that's not the case here, right? We are looking for price point, and we are going short on the point at which the price is overvalued, right? What is happening with Tesla is that many institutions are dumping the stock, and you are finding that a number of retail investors are buying the stock, thinking that we are buying the dip, and we are basically buying into a company that is fantastic, right? So they have a large backlog. The fundamentals aren't strong. They have depended over 15 years on various government subsidies. So fundamentals are not strong. So if you're asking whether we are following what other analysts are saying, no. If that is what you mean as contra, no, right? We are not following other analysts. We are doing our own research.
Okay.
So we will not take another analyst's work and then say, okay, this is fantastic.
No, I didn't mean that.
Buy this.
What I meant is, so we are finding out the vulnerable data points and we go short to create the extra alpha, or is it primarily we do the extra alpha by
Alpha is generated by undervalued stocks mostly, right?
Okay.
So if I just go back the slides, how alpha was generated, the proprietary alpha is basically low variability. Most of the alpha is generated by finding undervalued stocks well ahead of time. There will be a small amount of alpha that comes out of shorts, but shorts are not the primary source of alpha at all.
Okay.
The source of alpha is finding stocks that are 60%, 70%, or 80% undervalued 2 years or 3 years before your standard market analyst talks about it. So by the time the market analyst talks about it, we are already out of that particular stock.
Okay. And what is this commodity beta? I didn't catch that.
Market beta is the correlation to the market. Right.
When you say commodity beta, are you saying about metals and other things, or?
No. The commodity beta means it's basically a common factor that every fund uses.
Okay.
Right. So every fund in the world uses these 3-4 factors. Right.
Okay.
And every fund is going to generate beta. So what we are saying is, if I'm generating 10% returns, 2.2% of my returns came from sort of commodity factors, meaning market beta, size, valuation, etc.
Okay.
3.6% of my return came from profitability and basically the hedge overlay that we're using. A vast majority of the alpha, 5.4% of my 10% returns, came from integrity and health factor and eco-efficiency factor.
Okay. Thank you.
We don't trade any commodities at all. We have stocks only.
Okay. Yeah.
Any other questions?
I've got one, Samibai. It was a really interesting session. Thank you. On your learning portal, is there like a glossary of terms? So there's an explanation for all of these definitions, because to try and get my head around it, it's a bit complicated right now. So there's somewhere I can go for easy reference so I can understand it in layman's terms.
Yeah. There's basically there's a basic curriculum. So that has number of tracks in there that talks about understanding the vast majority of the terminology, and then the second part is the actual e-learning course itself, where kind of go through the various sessions, and then there is also the various articles from Substack and the YouTube, etc., which are consolidated in there, ordered by various topics. Such, yeah.
That sounds great. I'll definitely be checking that out. Thank you.
Sure.
Yeah. Soumi, can I put a request next session, if possible?
Yeah.
I understand this on a high level. You have explained this, but can you take one stock and help show us how you are analyzing, or how, on a broader perspective, going through all these parameters, how you are analyzing the stock and considering it to be
we do that.
Fit for purpose, or
There's about every year we are doing about 20 stock teardowns. So it's all there on the Substack. So if you go into soumivj.com, right, the Helix Substack. So over there you will find easily somewhere about 30, more than 40 stocks that we have done, stock teardowns. So how this model has been used on that particular stock, and some of them are videos, some of them are basically written, summaries itself, right? So it shows, why we basically selected this, how we analyzed, etc.
Which one? Where you said?
It's on the Substack. It's on the
Substack.
Substack, soumyvijay.com,
Okay.
right? There's or if you go into the portal, on the portal Learning Hub, there's basically a section for stock tear downs. So it should show you somewhere like 20 to 30 odd stocks that we've done. And then on the events calendar, you will find the next one that is coming up, right? If there is there's another stock that we are talking about, you will find that on the events calendar. That's also on the Learning Hub itself.
Okay.
I think this Saturday we will be doing a session on sentiment, and then next week we will have another stock tear down. So it should go up on our events calendar as well, right? So later this week I'll post it on the events calendar. We should be looking at another stock next week.
Is there any social group or anything where you can post it so that we can all join? Because I else will miss any notification coming out of the portal.
Yeah, there is a WhatsApp group. Happy to add you into that. Yeah, there is a WhatsApp group that we created, I think about 6 months ago or so, right? So there's one group that is there. Keep posting stuff on that. But what we are also doing is the portal should start sending you email notifications going forward, saying this particular there's a new topic that we are covering, etc. Right? It should start coming up. So
Okay. Yeah.
yeah. So I think that's it. If there are no further questions, I'll share the recording. It should go onto the Substack, and you'll see a link coming up, right? So thank you.
Thank you.
Yeah, thank you. Thank you so much.
Thank you. Thanks.
Thank you, Soumya. Thank you very much.
Thanks. Thank you. Bye.
Bye.
Thank you.